I'm trying to contain myself, Scott, but it's difficult. I think this move today is one of the most idiotic moves I've seen in the markets in quite a long time. Today's news is not news, okay? Last week you had the CPI and PPI for the month of January. They showed that inflation blipped up in January. PCE today for the month of January, which I will remind everybody was 24 days ago that it ended, is once again showing it hot. Okay, that tells us nothing about where we're going. Prior to that, you had 3 months in which inflation reports came in better than expected. So the question before us, Scott, before the Fed, before any investor, is which is the true story? Is January a blip, or is it a new trend? And if you look at commodity prices, if you look at goods prices, they are clearly showing that the trend to disinflation is intact. The question that hangs there, Scott, is what's going on with wages. I don't know the answer. Nobody knows the answer until we get next week's labor report. But to trade down today, whether you're an algo or a person, on yesterday's news, which is what today's PCE is idiotic.
Today's news, Weiss, Mester, inflation's too high, do a little more to get price stability, bring interest rates above 5%, hold them there. How do you see it? I mean, Jim, he used the word idiotic on the sell-off.
You know, if I were on the wrong side of the trade, I'd probably think it was idiotic also, but I'm not. So I continue to be bearish. This fuels the bearish narrative. It fuels the narrative of being higher for longer with the Fed. The Fed is going to err on the side of doing too much. And I'll go back to what I said yesterday and all these times before. Both can focus on a single data point. They can explain away, say, this was expected, are you guys idiots? What's new here? Which is essentially what we saw just now from my colleague here. But the reality is that it's directional. The economy directionally is slowing while the Fed is raising rates. So what's idiotic is to have multiple expansion in that environment. Multiple expansion's fine when you have trough earnings. We're nowhere near trough. So the market is way overvalued, will continue to decline as the economy worsens and inflation stays stubbornly high.
I feel really bad now. I feel really bad because now I realize I just pulled a Weiss saying idiotic. You're right, Steve. I shouldn't use idiotic. Because that's your venue to say things.
It's fine to use, Jim, when you're talking about yourself, but not about others.
Delusional, insane, stupid, stupidly insane, criminally insane. I mean, the number of adjectives that you've used when things are not going exactly your way to explain away data points is prolific.
But I mean, your case, let's be honest, okay? It's very easy to be negative. I totally get it. But your case is harder to make because a good economy, like you've been pointing out, only means more activity from the Fed, right? It means more demand that they need to crush. It means rates are likely to continue to move up or at least stay elevated. And that's a problem for stocks, isn't it? Regardless of how idiotic you think this move is, that is a problem. And that's what Michael Hartnett talks about today and why he says from the Bank of America Flow Show, S&P goes to 3,800 by March 8th. That's, a couple of weeks away. He essentially makes the case. Rates up, stocks down. Not that complicated. Yields are going to go north of 4%, and the S&P is going to go lower.
Good job bringing it down to taking the insults out. I applaud you for that. Give me next week's labor report. Let's see how average hourly earnings are. I hate to wait 3 weeks for the CPI, PPI of February, but I'm telling you, this is one man's opinion, just one man's opinion. As far as what the Fed is going to do and the impact on the markets, you need to see February's inflation report to determine if January was an outlier or the start of a resurging inflation trend.
All right, so Brenda Vingello, join the conversation. Weigh in on this little mini debate that we've had to start the show here on the desk.
Sure, thank you. So I think that it could be that January just ended up being overly hot. That's the time of year when everybody puts through a price increase. Usually salaries go up. We also had that significant increase in Social Security benefits that really probably boosted consumption during that time. But at the end of the day, I think if we look at data right now, you cannot deny that the consumer is still incredibly strong. They're not spending on all the things they spent on during the pandemic, but they're absolutely spending on all kinds of other things. Like travel, as we heard from Booking, things are really fantastic. They're spending on events and concerts. The consumer is still really strong. So I think even though that likely means the Fed is going to continue to raise interest rates here, I also think it might paint a little bit of a different picture in the shorter term for corporate earnings, because I think we had all been expecting that things would be really starting to slow down. that companies would no longer be able to pass along price and higher costs. And that dynamic might change a little bit, particularly for those companies in the services sector where we're still seeing demand be really strong. So I think it's not all potentially negative here, but are we in for a choppy period? I think absolutely, until we can sift through all of this and really understand exactly what's happening. But in my mind, it's clear that the consumer is really strong, and that's such an incredibly strong part of our economy that in my mind, that's a positive.